companies that are disrupting each of these industries are not the companies that are making money. They're the companies that are spending money. And the money is being made where that money is being spent. And that money is being spent in the technology sector with my sort of companies, which make this possible.
I've always personally been very interested in investing. My background as a chartered accountant working in financial services lends itself to that. I've also been very fascinated by technology, and it's the intersection of these two areas that we look at today. I'd like to welcome today's guest. Can you please introduce yourself?
Yes, I'm William de Gale, and I'm the fund manager of the BlueBox Global Technology Fund.
Can you tell me a little bit about your background, perhaps a snapshot of your career to date?
When I left university, I qualified as a chartered accountant, as you did, Tom. And then after doing that for about 4 years, I decided to do a bit of a change. So I followed my little brother into the army, and I spent 5 years in the Hussar Cavalry doing a variety of different things, a lot of them involving horses. And then when I came out of the army, I then joined what was then called Mercury Asset Management, which was Europe's leading fund management firm. And I arrived in the middle of 1997, and I was the most junior person on the team. So they gave me the technology sector because they assumed I would know about technology better than anybody else. And I've been covering technology ever since. So that firm Mercury was acquired by Merrill Lynch a few months later. And then the Merrill Lynch business was then sold to BlackRock. So basically I spent 20 years to the day working for BlackRock and its predecessor companies, covering the technology sector and investing in tech. And then in 2017, I left BlackRock and I co-founded a new fund management firm, a very small one, called BlueBox, in order to continue the strategy I've been running. I ran BlackRock's offshore global technology fund for just under 10 years.
Fantastic. Thank you, William. I'm very interested to learn about what you often refer to as direct connection. What exactly is direct connection?
So direct connection is really my sort of explanation for why the rate of technology change in our lives, both our personal lives and our business lives and government and so on, has accelerated so much in the last 10 years or so, because it has been very dramatic. And a result of this change has been that if you look at it from a company point of view, almost all profit growth in the US market, for example, has been by technology companies. There's been no profit growth since 2012. Outside the tech, or in the S&P 500, excluding the tech sector, in those 8 years. And that takes explaining. And to me, the reason is that around 2005, the way that computer systems operated changed very dramatically. And we didn't really notice at the time, but it is a huge change. In the 20th century, computer systems relied upon human beings as the input and output devices because computers don't understand the real world that we live in. They live in a world of ones and zeros, and they don't understand analog, continuous variables, the real world. So we, the human beings, would typically use a keyboard to translate the real world into some sort of digital format that the computer could understand. And at the other end, the computer, having done something very clever, would produce a digital result on a screen, on a printout, and we, the human beings, would read that and act on the world. So we were the input and output device for the system, translating analog to digital, and then digital to analog, and then acting on the world as a result. But from around 2005, that really began to change dramatically. So the Internet of Things is a big element of this. The system now knows something about the world for itself. So it's a very limited aspect of the world, but it knows something for itself, and there's no need for a person with a keyboard to type information in to tell it what's going on. And at the other end, increasing, the system is acting directly on the real world. So robotics, automation, two huge areas of this. So the human being has now set the system up, but in such a way that we can then step back and just let it get on with itself. And we've taken ourselves out of the loop. And by taking the human beings out of the loop, processes run millions of times faster because we were by far the slowest bit of that system. And if processes can all run millions of times faster, then hundreds of times, or maybe even thousands of times, more applications become possible. So things that were simply impossible in 2000 are now just very difficult indeed. And the technology sector is all about doing very difficult indeed. That's what the sector does. And this single break has been taken off all of technology at the same time in the last 10, 15 years. And that has really begun to get going in the last 10 years. And it really explains almost everything that's exciting in technology at the moment and the disruption which technology is enabling around the world in different areas. If you think about almost anything that's going on out there, it relies to work well upon the system being able to connect directly to the real world without relying on a human being to input data and to read the results and act. So if I give you an example, if you're going to get a parcel delivered to you tomorrow by, let's say, a shipper, UPS, you'll get a text message the night before and that morning saying, George will deliver your parcel at 11:20 to 11:30 tomorrow morning. Now, in theory, in 2000, you could have achieved that by giving George a mobile phone and a map, and he could have phoned the office every half an hour to say where he is and where he thought he was going next. And there'd be someone at the office typing that into a computer, and the computer would stick all the information together and work out where all the Georges were and where they were going to go, and then put something out on a screen, and some nice person would then tap that into a mobile phone and send a text to you, the recipient. So in theory, it could have happened, but in fact, it's totally impractical. So George would have misread his map quite often. He would have crashed his van because he's not concentrating. The size of the call center will be absolutely vast. People will get very bored of typing messages into mobile phones. And it really doesn't work very well at scale at all. But the moment you put a little box on the dashboard of George's van, it suddenly becomes easy because that box has got GPS in it. So it knows exactly where it is and where it's going. And every 30 seconds, it sends a message back to the servers in the office, the computers. And the computers digest all this information from all the Georges, and they send the text messages, and they send the message to George to tell him where to go next. So the moment you put that little box on the dashboard, you've taken the human beings out of the loop. It now goes from satellite to GPS box to the computers to the text message to you, the end user, without human intervention. And it becomes quite a simple problem, but it's only a simple problem because you've connected the system to the real world at the beginning and the end. The system knows something about the world, where it is, where it's going, and the other entity is acting directly. It is sending you the text message. So that's a very simple example, but you go through almost everything that's going on in technology at the moment, and all of it depends on taking the human being out of the loop in order to make things run much, much faster.
In many ways, it's automation resulting from sensors, allowing the computers to do pre-derived functions without any human involvement.
I think automation is a huge element of it, but to me, it's a bigger thing than automation. It's a much bigger movement of stuff. Automation almost captures it, but in my mind, not quite. It goes a little bit further than that.
That's amazing. So a lot of possibilities open up as a result of this, self-driving vehicles, etc., where human elements would have led to lengthy delays or errors, and these things now become practical with the intervention of direct connection.
Absolutely. Baidu and Google would not have spent billions of dollars on developing the software, the artificial intelligence for autonomous cars in 2005 because the sensor processing technology simply wasn't good enough. The system could control the vehicle, that wasn't too much of a problem, but the automatic driving system needs an incredibly large number of sensors and a vast amount of data coming in. And in 2005, that massive data from all these sensors was simply too big for the central processing unit of a car to deal with. But the breakthrough was to put some of that processing technology at the sensor end. So rather than the sensor sending all the information back to the middle where some huge brain had to work out what was going on, it would only send back the relevant stuff. So the sensor, or something very close to the sensor, could work out what was important and filter what it was sending back accordingly, reducing the burden at the center. And that suddenly made autonomous driving possible. Hugely difficult. It's an enormous challenge, but at least it's possible. And it meant that before that, you could have had the best AI in the world for autonomous driving, but it still would have relied on a person sitting in the front seat of the car, looking through the windscreen and typing on the keyboard what he or she could see. And we just can't process the information fast enough. We can do that fast enough for us to drive. We can't do it fast enough to get it into a keyboard and stick it into the machine. And anyway, it wouldn't really be autonomous because we're telling what's going on. So it wasn't until that key change in sense processing technology happened that autonomous vehicles became even vaguely viable.
I suppose, William, in a larger sense, these advances you talk of facilitated the Internet of Things, which is huge.
Well, the Internet of Things is really part of this, so it's enabling this to go on. So it's a big aspect of the input side. So a lot of what we're talking about here is sensors, processing, at the edge, communication, storage, all the stuff you need to intelligently process stuff near the edge and send back what's relevant to the middle, so that the central unit can work out what's going on in time to do something about it and react to the world. So the Internet of Things is a vast and growing element of this. But again, it's just one aspect.
What was it that piqued your interest and enthusiasm for this sector, the interaction between computers and real life direct connection? What was the thing that convinced you or made you passionate about it as a subject matter?
So it was in about 2005 where I wrote a note about the companies that were using GPS, so positioning systems, for commercial purposes rather than for driving a car around. And I wrote the note and called it "Computers Come Out to Meet the Real World," because to me this was something new, that the system suddenly knew something about the world and it could do something with that information. And this was for building sites and smart agriculture and fleet management and stuff. There were lots of applications, but it was all to do with positioning. And every now and again, I would add to this category in my sort of universe of stocks another company that seemed to be doing something similar, that was connecting systems to the real world. And this category got bigger and bigger and bigger until it threatened to take over the entire universe as far as I could see. And I realized that actually everything that I was interested in investing in almost everything was related to this single theme. And then when I really thought hard about it, I realized that this single theme lay behind almost every exciting disruptive technology that my competitors were getting very excited about and investing in. And I never really liked the extremely exciting, disruptive, fast-growing companies because as investments, they're useless. They're dreadful investments normally. They go up very fast for a while and then they go down even faster and you're left with absolutely nothing. And when that turning point comes, it's very difficult to detect. But I've always been interested in the companies a little bit behind them, the ones that were enabling what they were doing to happen. They were all direct connection stocks. So I eventually went through my portfolio thinking, okay, well, I'll see which of these are direct connection stocks and which ones aren't. And I couldn't find any that weren't, to be honest. They all seem to be direct connection aspects to one another. At that point, I was just beginning to think of it as direct connection because I was launching this new fund and I needed a snappy title for it. And to call the fund the Computers Come Out to Meet the Real World Fund really didn't sound particularly good. I needed a way of putting it into 2 words, and in the end, direct connection seemed to be about as close as I could get.
You mentioned that you run this global technology fund called BlueBox. Can you tell me a bit about what type of asset BlueBox typically invests in and something about your investment strategy?
Yes, it's very traditional assets and it's a very traditional approach. So it's equities. And so we're only investing in public equities with a market cap of more than $1 billion. So it's very straightforward. No derivatives, no shorting, we don't borrow. So it's very much plain vanilla, old-fashioned investing. And we tend to buy these stocks and then hold on to them for many, many years. I mean, really many years, 10, 15 years sometimes. We might change the weights quite a bit, but the holdings, once we own them, we expect to own them for a long time. And theoretically, that shouldn't work in tech. Tech is supposed to be this fast-changing industry where everything's different every year and you have to be on the latest theme and the hottest stock and beat everybody else to the turn. And actually, when you look at the results of tech funds that are trying to do that sort of thing, which is almost all of them, they're awful. It's very difficult to beat the index if you're doing that sort of thing. Was actually finding the companies that are making that disruptive stuff possible is much, much more productive because those companies don't tend to change very much. The company that enables it, I've got one company which has allowed an oil refinery to be upgradable without being shut down and cooled down. They also enabled a new wealth management system for a major Swiss bank, and they completely reorganized the drug discovery system of a pharmaceutical company, and they developed one of those shipping systems, the notification system for the end users. So that's a single company which created the software for all these different disruptive technologies. I'm not interested in the oil refinery or the wealth manager or the shipper or the pharmaceutical company. I am interested in the company that made all that possible for them. Because the companies that are disrupting each of these industries are not the companies that are making money. They're the companies that are spending money. And the money is being made where that money is being spent. And that money is being spent in the technology sector with my sort of companies, which make this possible. But they're often a little bit older and a little bit more boring. So people simply don't want to see them in their tech funds. Neither the fund managers nor the owners of the fund, the investors, want to see older and more boring companies in a tech fund. But that's very silly because those are often the best companies in the industry. And the reason they're still doing what they did 15, 20 years ago is because what they're doing is incredibly lucrative. And why would they go and find something else if they're still doing something that's important and no one else can do and it's really making money for them? So I'd much rather find that sort of company that's a little bit overlooked because it's a bit too old, a little bit too boring, but it's doing something vitally important that no one else can do. That's my sort of stock. And no one else needs to be doing that. That's not really how people invest in tech.
So it sounds as though you're literally going for the stock picks and shovels, as in the gold rush.
Absolutely, yeah. I'm much more interested in selling picks and shovels to the gold miners rather than staking a claim myself.
Fantastic. And specifically, William, where is BlueBox currently investing in terms of sectors and major holdings and geographical split?
So in terms of sectors, we're almost entirely in the tech sector. So we own a few companies that are classified as non-tech stocks, but really they're tech stocks in disguise. So we're basically investing in technology companies. Geographically, the biggest country that we're invested in is clearly still the US. So the US has most of the key intellectual property still in the industry, and it dominates the value in the technology industry. But we have significant holdings outside the US, quite a lot in Asia, a bit in Europe. My favorite stock actually is in Latin America. So we have a good geographical split. And that's not dissimilar. We're probably a little bit less in the US than most tech funds, but that's mainly because we don't particularly like the very biggest stocks. So the tech mega caps I'm not really very keen on. So they dominate almost every tech fund out there, or every large cap tech fund out there. If you look at the top 10 holdings of almost every large cap tech fund in the world, 8 of those 10 names will be taken from the 12 tech related mega caps. I just don't really think that makes much sense, because most funds are devoting more than half of their capital to the winners of the last round of disruption, which is what a mega cap is. And collectively, those companies will be the losers of the next round of disruption. There's almost no doubt about that. That's how the tech sector works. These companies look at any moment as if they're completely invulnerable and nothing can possibly diminish their strength and their importance. And that's when something comes along and diminishes their strength and importance. And they don't disappear. They just grow more slowly than the rest of the market. Their stock underperforms. And in 10 years' time, you'll find that they're not very important businesses anymore. So I'd much rather focus on the companies a couple of levels down. So typically we're looking at companies with a market cap of, let's say, $10 billion to $100 billion. So these are really big to absolutely enormous companies, but they're not the mega caps, the $250 billion plus companies.
So if you're focusing on companies a couple of levels down, what do you see as future trends in tech, or how do you identify these in order to pick up on such firms?
The nice thing is that I don't have to identify the future trends in tech. And I think unless you're actually living in Silicon Valley, it's almost impossible to do so. But unfortunately, that is what most tech investors are trying to do, because they think that's what their job is. They're misunderstanding what the job of a technology investor is. So the job of a technology investor is not to invest in technology. It may seem strange, but it's not. The job of a technology investor is to invest in technology companies. And in order to have any value, a company has to create value for its outside investors. Or what's the point? If it doesn't create value for its outside investors, it's called a charity. And that's not an investment. That's where you give your money away. And if you're lucky and it's charity lottery, maybe you make some money, but that's not what it's about. Essentially, it's making the world a better place, and it's what you spend your money on. I'm investing my clients' money. So I need to see some way that those companies are creating value for my clients, the outside investors. And that's a fundamentally different way of looking at technology investing to most of my peers, because they don't seem to think that value creation is important. It's always something that can be put off until tomorrow. And who owns the value that's being created is not even regarded as a question in the tech sector. But the problem is things like stock compensation, acquisitions, annual restructurings, all of which people ignore every year in the results and extract from the earnings. Actually, that's value going to insiders or other parties other than the outside investors who are my clients. And so those things are actually incredibly important. For me, I often find the most interesting bit of a company's results are the non-GAAP adjustments. So the adjustments to earnings to exclude all those things like stock compos, acquisitions, restructuring expenses, which are sort of a bit annoying and maybe not cash expenses of this year. And so we'll just ignore them. But actually, they are the problem with the company. So that non-GAAP adjustment immediately highlights for you what the problem is with this business, what the weak point is. And so I love non-GAAP adjustments because they do my work for me. They basically take me straight to the issue. And if the issue is that the company before stock options is profitable, but afterwards is making a loss, well, then it's pretty clear where the value is going. It's not going to the investors, it's going to the engineers because they're the scarce resource, which is often the case in technology, particularly in Northern California. And that's sort of my approach. And I don't need to find future trends because the company that is making the hot theme next year that we begin to hear about In order to make that work, they will have had to be connecting their systems to the real world, because that's the key element of everything. And so they will have been buying stuff from my companies, whether it's hardware or software or services or whatever. They will have been buying stuff from my companies for several years before we hear about them. So I've already had exposure to that new theme before it's even sort of risen over the horizon. So I don't feel a need to chase hot themes, and that makes life a heck of a lot easier in the tech sector. So
I can imagine so. So you don't have to chase trends because they're effectively coming to you already through the holdings that you've got.
Exactly.
You spoke of value creation. What sort of returns have you seen on your holdings in the fund?
So the fund didn't launch very long ago. So we're talking sort of in the middle of July 2020, and we launched at the end of March 2018. So at this point, it's a little bit over 2.25 years old. And up until the end of June, it had generated an annualized return after fees of around 18.5% a year. So I think we're about 50% up over that 2 and a bit years. And this strategy, if you look back over my time at BlackRock as well, running essentially the same strategy in my old portfolio there, it does generate a mid to high teens net return. And this is for a fund with daily liquidity. I said very plain vanilla. So there's no shorting, there's no leverage here, no derivatives. It's just buying and holding stocks. But it's generating a very decent mid to high teens return after fees. There's no guarantee that will continue, of course.
Stocks can go up as well as down.
And go any way they like. I think the tech sector is going to go on up for a very long time because this direct connection is an enormous change. And while lots of stuff appears to happen very fast and everything's always changing in tech, the big trends take many decades to work their way through the system. So we're still feeling the benefits now of Moore's law, and that concept was developed back in the 60s. A big change like direct connection, where the entire principle of computing, the basis that computing works on or computing systems work on, has changed. That takes many, many decades to find its way through the system. There's just second, third, fourth, fifth order effects. So we're really early in that. So I think technology will continue to dominate earnings growth for the entire market for a very long time to come.
Because we're talking in July 2020, as you mentioned, I have to ask about coronavirus. How has COVID-19 affected the tech sector and your fund, both in the short and longer term, do you think?
So in the very short term, it went down a lot, as everybody's did. We didn't go down as much as other sectors. We didn't go down as much as the tech sector indices did, but we went down. And then we went back up again. Because what COVID is doing is essentially accelerating the long-term trajectories of most of my companies. Everything that was sort of good about the tech sector as an investment, the way that lives are changing, that we're relying more on technology, less on physical movement, we're doing more online, software is moving to the cloud. All these things are the drivers of technology spend. And all of them have been accelerated by the need to work from home, the need to make a society maybe that's a little bit more sustainable as well. Every trend that was going steadily at the beginning of the year has accelerated to the extent that really I think, and several people have said this isn't a novel idea, but I think we've had about 3 years of that trajectory squash into the last 3 months. It's no real surprise that at the moment tech stocks are worth more than they were at the beginning of the year, because very few of them are going to get into real difficulties in the current environment. Bigger tech stocks are very cash generative businesses. They don't have any debt. Even when things are tough, they tend to still generate cash. So they're not going to go out of business. They're still going to be there at the end of this year, and their long-term trajectory is better than it was at the beginning of the year. So they will be worth more at the end of this year than they were at the beginning. And the market doesn't wait for the virus to go away to price that in. I mean, the moment that's apparent, that goes into the price, and that's what's been happening. Tech stocks, just in the right place at the right time. The trends that were positive for the sector are even more positive now as a result. And as long as the economy doesn't totally collapse, which was what the concern was in mid-March, as long as the economy doesn't totally collapse, these businesses are better, more valuable businesses than they were at the beginning of the year.
It's been a fascinating insight into your approach to technology investment, William. Thank you so much for joining us.
It was a pleasure, Tom. Very good to speak to you.
And thanks to everyone for listening. We'll see you on the next podcast. I hope you enjoyed this episode. Please do share it on social media and give us a rating on Apple or Spotify. If there's an industry leader you think our audience would like to hear about, or if that person is you, do get in touch. We'll see you soon.